Okay, I know you probably heard a lot about the chunky method, which is the velocity banking way of paying off your mortgage in record time. You guys, it's not as hard as you may think, and I can tell you there's more than one way to skin a cat, even if you don't have a HELOC or a PLOC. But I need you to give me one moment. I'll be right back.
I'm a stranger, a willing.
Okay, just as promised. You hear a lot about people talking about using velocity banking. I'm going to chunk my mortgage. What they're basically saying is that they're going to send a lump sum payment to the bank and they're going to say, I need you to apply this not towards my interest or to the whole entire balance. I want you to apply this directly towards my principal. Now, remember, you're going to still make your normal, typical, standard monthly payments, but now you're actually bringing down your mortgage principal in record time. In this case, this person here, they have a $200,000 mortgage. I have talked to them. Now, this person happened to have a savings account. You guys, I'm learning something. Everybody is not for taking out a HELOC because they looked at it like, no, it's tied to my home, the collateral, they're risk averse. They don't want to leverage their home as a way to pay down their debt. So in this case, they had tens of thousands of dollars in a savings account. So I said, listen, when we do this, remember, you're going to pay yourself back. You're simply borrowing $20,000 from yourself. You are now the banker, and you're going to pay yourself back every single month. In this person's situation, once again, we're looking at $20,000 on their mortgage. They took out $20,000 and applied it directly towards their principal. I mean, either calling the bank or going in there or doing it online. But you want to make sure that you're not just sending $20,000 to the bank and saying, hey, put this on my credit. I ate $20,000. You want to be intentional about putting it towards the principal payment. When I say that, it's because when it goes towards the principal, as the principal is paid down, they can charge you more interest, okay? So the goal is here is to run down that principal as quick as you can. That way, you're no longer feeding the interest cycle, okay? So as I said before, everybody is not comfortable taking out a HELOC on their home, like a line of credit. I do get it. Because you miss a couple payments, maybe something went awry, and guess what? Your house can be on the line. So for those people, and this person here, they had savings account. Some people might have a 401k. You have to do what's comfortable for you. Some folks are like, oh, I'm not going to risk my 401k. Once again, it's a personal choice. You have to decide what's best for you. But if you look at this method I'm suggesting, you can go ahead and you can take out the $20,000 out of savings, out of even a credit card for some people, or out of your 401k, but you're going to pay yourself back. By that, I mean, once you withdraw the $20,000, we're going to work on paying this back every single month. This person had $2,000 cash flow. When I say cash flow, that is the money they have after they paid all of their bills, they've done all of their expenses. And I'm going to stop and say, the method that I use, I always tell people, look, let's delegate fun money. Fun money is things like drive-ins, movies, nails, pedicures, manicures, date nights, maybe even buying clothes. That's when you're going to designate every single month for you. And I'm going to say this, if you have a problem with spending, when you have let's say your fund money is $200 a month, that's not unreasonable. Take the $200 out of the bank account, put it in an envelope. When that envelope is empty, guess what? You can't spend anything else. You can't go to the bank and say, oh, I got more money in the bank. No, that is your fund money. You've designated that. You've been strategic with that. When that envelope is empty, you guys, you cannot go back in there. That is how you start to build up momentum and you start to be disciplined in saying, if I don't have it, I'm not going to spend it. So once again, I digress. But we're going to say when we do this method here, I'm going to encourage you to take out some fun money. So you don't feel like you're depriving yourself. It's like a diet. You feel like you can't have any food or any fun, you're going to pretty much give up on your diet. But if we have some fun money as we're paying down our debts, we're more apt to go ahead and pay down those debts and stay on track. So in their case here, after all their bills are paid, they have $2,000. So if you haven't found out and figured it out by now, I'm going to say strategically target that $2,000 to pay yourself back, which means after you paid all of your bills, put the $2,000 back into your account. If you do this method, you guys, guess what? Within 10 months, you're going to pay yourself back that $20,000. Then yeah, let's go back in. Let's chunk again. Let's take the $20,000 out again. Let's do rinse and repeat. We're going from 180. Now we're down to 160. We're going to go ahead, do the same thing. We're going to rinse and repeat. $20,000 taken out, calling the bank, going into the bank, we're going online, putting the additional $20,000 directly towards your principal. Now you're down to $160,000. And once again, rinse and repeat. We're going to go ahead and we're going to allocate the cash flow every single month of $2,000 back into our own account. 10 months, you guys. Let's do it again. rinse and repeat, $20,000 injected directly into that principal of that mortgage. Now we're down to 140. But something you're probably not following along, every time you make your payments on this mortgage, let's say you're at 10, 20, 30 months, remember, so much of that is going towards your principal. Let's say they're here maybe possibly in let's say they had a really good rate, 2.75%. They have a 30-year term, but every single month we know that about $500 of that is going towards their principal. Let's go ahead and take that $500, let's times it by 10 months. They've actually paid $5,000 in addition to what they had with the 180 as well. So what I'm trying to say is, as you're continuously making your mortgage payments, you're still paying them. Remember, so much of that is going towards your principal, so much is going towards your interest. In this case, if they have $500 going towards their principal, in 10 months, they have paid that thing down to $5,000, even more. So this number right here really should be 175. So once we inject that additional $10,000 into the 175, we're at 155. So you guys, my chart, don't pay attention to my chart. It's just a standard chart. But I'm talking about, if they have paid their mortgage payments on time, they have paid $5,000 additional principal. So let's say we're at 175. Now we're down to 155. But remember, we've done this now our third time. Now we're down to 135, you guys, on that mortgage. That is 30 months, less than 3 years, that you've actually chunked off $20,000, $40,000, $60,000 in, you guys, principal payments. Now you're down to $135,000. But wait, remember, as I told you before, every time they've actually chunked that thing and they paid 10 months of making those payments, they've hit it down $5,000. So in actuality, that 155 should be 150. Okay, let's say we're going to chunk another 20,000. Now we're at 130. But that 130, because they paid 10 months of mortgage payments, and remember, so much of that goes towards the principal, that should be what, 125. You guys, in 30 months, less than 3 years, they have paid off $20,000, $40,000, $60,000 by chunking that principal in their mortgage. And also, I want you to remember, they're also building equity. They say typically a house is going to appreciate 4% every single year. If they decided, you know what, I'm done with this home, I want out of this home. Look, you guys, you're about at 120, 125, 125,000. The house has gone up in value every single year for the last, 3 years. The house probably worth about 250. If they jumped out now, they can really pay all of their settlements and all those kind of things. They can walk away probably free and clear with about $120,000. You guys, that is not bad. So if you decide, I don't want to stay in my house for the whole entire 30 years, I want to stay here for 5 or 7 years, the goal is that you would chunk off as much principal as you can. Now, if you want to use a HELOC and you have a 401k or you have a savings, use that savings, use that 401k, only because you're going to pay yourself back. Number one thing is here, there's no interest payment because you're paying yourself back. Now I get it with the 401k, when you pull it out, there's going to be some payments you have to do when it comes to state taxes and things like that. But you have to make that decision for yourself. Do you decide that, hey, I can eat maybe the 20% tax, the hit on taxes, or I don't want to touch that. I have a savings account, I'm going to touch that. Remember, there's no interest payment. So you're directly borrowing from yourself and paying yourself back. And most folks don't charge yourself interest to pay to use their own money. So just another way to tackle that mortgage and pay it off if you do not want to use your personal money. But I'm going to tell you something here. If they continue doing this, let's say within maybe 8 years, this house is paid off free and clear. They own the house outright. It becomes an asset. They can decide to stay in the house, or they can decide to rent the house out. And guess what? Now they have a cash flowing asset. That house is probably going to be worth about maybe $260,000, $275,000. So now they've gone from a house that they bought, $200,000, but within 8, 9 years is now at maybe $270,000, $260,000. They have a cash asset. They're building their real estate portfolio. And guess what? They have no mortgage. Now, of course, you have to pay your taxes and insurance, you guys, but that's like maybe $400 or $500 a month compared to $1,600, $1,700 mortgage payment. So once again, if you don't want to use a HELOC to leverage your home because you don't like that collateral, knowing that if something were to happen, you lose your home, try maybe dipping into your savings or maybe your 401k. I'm just a voice, you make the choice. But remember, always say, if you don't tell your money where to go, you're going to wonder where it went. In this case, We're telling our money to go and pay off our mortgage payment, to get us out of debt, to get us closer to debt freedom. Also, remember, you can rinse and repeat. You can do the same thing with anything, any debt, even student loans. But to the next video, I'm Julia, financial freedom friend. I'm here until you win. You found worth in this video, please like, subscribe, and share. Sharing is caring. We'll see you soon. Bye-bye.